If you're planning to buy a home, you've probably heard things like, you need perfect credit, or just pay everything off and you'll be fine. In reality, credit and income are evaluated differently than most people think. And well-intended moves can sometimes hurt your approval or cost you money. In this video, we're going to break down how lenders actually look at credit and income, what matters most, and what you should and should not do before applying for a mortgage. Your credit score does three things in a mortgage transaction. Determines whether you qualify, impacts your interest rate, and affects the mortgage insurance costs. Credit scores are pulled from all three bureaus, and most lenders use the middle score. Important reality check: there is no perfect score you need specifically to qualify. And improvements beyond certain thresholds often have diminishing returns. For conventional loans, major pricing tiers change roughly every 20 points. That means going from a 739 to a 740 can matter, but going from a 780 to an 800 usually doesn't. Paying off debt can help, but not always. Common mistakes are closing old credit cards, paying off installment loans right before applying, or draining cash reserves to pay balances down. This can hurt because paying off loans can temporarily drop your score, and losing reserves can weaken the file. This is why strategy matters more than rules of thumb. Sometimes the better move is to pay balances down, not off completely. Leave older accounts open and preserve liquidity. Hard inquiries themselves are usually relatively minor, but new accounts are not. New credit impacts your debt-to-income ratio, your credit score, your loan pricing, and the risk assessment. This includes credit cards, auto loans, store financing, buy now, pay later plans, as well as co-signing. If you're under contract or planning to apply soon, you may want to consider freezing your credit activity until after closing. Income qualification isn't about how much you make, it's about how predictable and documentable it is. Here's how common income types are treated: salary and hourly. For salary and hourly income, it's pretty straightforward. You qualify in your gross income and stability matters. With overtime, bonus, and commission income, we typically require a 2-year history. Must be consistent or trending upward and will be averaged, not projected. Self-employment income is more or less qualified on net income, not gross. Business write-offs reduce qualifying income, and trends matter more than one good year. A strong income on paper doesn't always translate to qualifying income. Here's a big misconception. I make 6 figures, so qualifying won't be an issue. If most of that income is written off, lenders don't see it the same way. Underwriters look at net income, business stability, year-over-year trends, and certain add-backs, which are limited. This is where bank statement or alternative loan options sometimes make more sense, but those come with trade-offs. We have a specific video on these alternate loan options on our channel and website. Student loans are calculated differently depending on the loan type. Even deferred loans still count in some form. This can drastically affect affordability if not planned correctly. However, you may be surprised to learn that student loans aren't always as big of a barrier to qualifying as most think. Regarding child support and alimony, these count as debts if you pay them, and count as income if you receive them, but only if they're court-ordered, documented, and expected to continue for a set period of time. Verbal agreements don't count. A borrower with $90,000 in stable income and a clean employment history sometimes may qualify more easily than someone with $150,000 variable income. Mortgage lending favors consistency, not upside. Here's how to prepare the right way before applying. Don't open or close accounts. Don't change jobs without informing your lender. Don't move money around unnecessarily. And don't assume higher income automatically helps. Instead, get your information and documentation reviewed early. Ask strategic questions up front, and let your lender help you optimize, not guess. Credit and income aren't about perfection, they're about predictability and planning. Most mortgage issues don't come from bad borrowers, they come from misunderstandings and last-minute decisions made without guidance. If you're thinking about buying, the best move you can make is getting educated early and working with someone who explains the why, not just the numbers. If you found this video helpful, please subscribe and follow us for more straightforward mortgage education content. Thanks so much for watching.